Welcome to the AWA Market Minute, breaking down current economic, financial, and political events that impact today's retirees. Our investment committee performs hours of research and analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring investment advisors Jaron Monk, Mason Page, Chief Investment Officer Scott Hoxer, and your host, founder and CEO Paul Coles.
Well, hello everyone, and welcome to this month's edition of the AWA Market Minute. Scott and I always look forward to being together with you guys every month and walking you through current events that pertain to your retirement. As always, the information that we discuss is designed for a broad audience. It's intended to be educational in nature and not specific advice for anybody on the call one-on-one. When you want to get that advice, you need to reach out to your team here at Alliance Wealth Advisors and schedule a time for us to review your situation one-on-one. So Scott and I were just chatting about the upcoming Super Bowl. It's on everybody's minds this Sunday, and it's kind of a fun event because I think it transcends, sports fans, right?
Yeah.
You end up with people that don't watch sports all year, but they'll watch the Super Bowl. It's a family gathering, and it's just kind of a big event that people enjoy. So do you guys have plans this weekend?
Yeah, we traditionally get together with the whole crew and extended family, and we'll have way too much food and probably more talking and eating food than actually watching the game.
And what's the number one thing most people are into during the game?
The commercials.
The commercials.
Yeah.
Okay. Everybody loves Super Bowl commercials. And I actually read an article this week on the Super Bowl commercials. Any guess, Scott, what is the average cost of one of these Super Bowl commercials this year?
$2.5 million.
$2.5 million. It's almost 3 times that. The average cost
Wow.
is upwards of $7 million. So
I hadn't made the inflation adjustments.
There you go.
That's why I was off.
You got to adjust for 2023 inflation,
right,
Scott.
That's right.
So I was curious as to why these costs were so exorbitant. This year, prepare yourself for an all-star cast. You've got Bryan Cranston and Aaron Paul, the 2 stars of Breaking Bad. They're doing a reunion for it's a popcorn ad or pop crackers or whatever they're calling it, and they're doing a reunion. So Breaking Bad fans will enjoy that. You've got Ben Stiller and Steve Martin doing Pepsi commercial together. You've got Will Ferrell, and there's a teaser out there. You can watch this Will Ferrell one, and it's a General Motors commercial, and it's like a Squid Game type deal, and it's a pretty funny trailer. John Cena, Dave Grohl of Foo Fighters, Paul Rudd of Ant-Man fame and all the other shows he's done, he's doing a commercial too. So most of the money that is being charged for these commercials is in the star power.
Right.
But can you imagine $7 million for a 30-second spot?
No.
I mean, that's pretty incredible. So football is on our minds, and that kind of got me thinking about the idea of political football, which is kind of a funny analogy, right? The idea of something getting tossed back and forth and being used in a gaming sport. And political football is something that we see regularly in our society today when it comes to different legislative opportunities that are coming up, and people say don't let any opportunity go unused to try to gain ground in politics. And so when it comes to things like the debt ceiling, that's a big political football that we see everybody kind of using to get to leverage and gain some political ground. The big one last year that kind of just wrapped up right at the end of the year was the Secure Act 2.0, and it's no longer being discussed because it's been signed into law. But now comes the hard part of understanding how it applies to our clients, to retirees in general. And so we decided, as we would go through this discussion today, we would bring a professional accountant on with us. So with that, I want to introduce our guest today. His name is Brent Beament. He's a certified public accountant and also a certified valuation analyst, so CPA and a CVA. And Brent is the founder and partner at Beament Company, which are certified public accountants. And they service over 1,200 households, so highly qualified, highly skilled. Brent, we're excited to have you on today's Market Minute.
Yeah, well, happy to be here. Thanks for having me, guys. And
yes.
Real quick on the Super Bowl. So even though it's a $7 million ad, a lot of times, like as an accountant, I'll just tell people to run the numbers. Like that could be an absolute steal for these companies, like getting that much exposure. But if they're getting a $50 million return, the $7 million might be absolutely worth it. But if you run
That's
the
good
numbers,
ROI.
it just might make sense. Yeah.
Yeah.
It's good ROI. Well, and I'm trying to remember and I don't remember, so clearly this is demonstrating it may not have been worth it, but there was an ad spot last year where all they ran was a QR code that bounced around the screen.
geez.
That was the entire ad. And they said that this ad was like super cheap, but it drew so much attention from the QR code that people were doing it that it just blew up all their servers. The whole thing fell apart on the back end because everybody was like, what is this ad? And they were all scanning it. So anyway, well, Brent, thanks for joining us today. And we're excited to kind of give you some questions that hopefully you can help us kind of navigate through and have a good conversation on. I think the first place I'll start, Brent, is a lot of our clients are in that retirement space, right? And they're getting closer or already into a place where they're taking distributions out of their accounts, or they're getting close where they might have to. And so required minimum distributions are on everybody's mind. And for years and years and years, that was age 70 and a half when those were to be required. And then the Secure Act 1.0 changed that. And now Secure Act 2.0 has changed it again. Will you give us an update as to what that now looks like?
Yeah. Yeah. Well, I think it's a great planning opportunity because as most of you know, an RMD is when you're required just to withdraw certain amounts from your retirement accounts. And most of the time it has a very significant tax impact. Like it'll push you up into other tax brackets. It creates taxable income and adjusted gross income. And we've got to account for that as we're doing the planning. So I think going from, if you're 71 years old right now, you do not need to take an RMD like you would have needed to a few years ago. Now you can take one if it makes sense. Like if you're in a low income year, it might make sense to withdraw. Or if you're in a high income year, you wouldn't want to be forced to withdraw it if you don't need the money and if you have a planning opportunity. So as I will typically say, we would want to run the numbers or work with Paul's team and run the numbers to see where you're falling on your tax brackets. And I think it can be a really good tool as far as the RMDs go. And then the change with the Secure Act 2.0, it bumps up the age up to 75. So now you'll have a few more years where you're not forced to take the money out. And so from my perspective, I think it's a great opportunity and just a good thing overall for people.
I like that, Brandon. And something that's interesting to me, I mean, think about the people turning 72 this year, right? Like that's some good fortune, right? Because under the original Secure Act, they would need to start an RMD.
Yeah.
Here in this year, the RMD age goes up to 73, and then in 2033 we have the step up to 75. So, yeah, kind of fortuitous for those who happen to be 72.
We're seeing
would have
people
otherwise had to take one.
Yeah, and you guys might be seeing this as well, but we're seeing people wanting to work longer. Like they might have a remote work. There might be jobs where you can continue to work at that age. And it's almost like you're being penalized. Like, well, I don't even need this money yet. And I'm still in this high bracket. And so you're forced to take it out and the money might just sit there, but you're going to be paying tax at the higher rates and instead of pushing it out until later when you're potentially in a lower bracket.
That's a fantastic point there, Brent. I guess I hadn't considered that. You're exactly right. I think we're seeing an aging demographic into the workforce, especially post-pandemic, where I think that there are opportunities to work now in more convenient ways, and people don't feel quite as rushed to leave the daily grind, so to speak, at 65. They can maybe work until their 70s and not feel quite as pressured. Talk to us about maybe some of the long-term impacts on things like Social Security. You mentioned that there's obviously like a flow through when you take an RMD, it changes your Social Security tax. You know, not all your Social Security is taxable based on how much income you have to report on your AGI, and even things like Medicare premiums.
Yeah. So pretty closely related to like the income tax, which is the brackets I was referring to earlier. But Social Security, as your income goes up, you're going to have it taxed between sometimes 0% if you've got very low income, of course, or up to 85% of your Social Security is taxed. And so when you're in that age taking Social Security, if you're forced to take the RMDs on top of that, you're paying tax on quite a bit of your Social Security. So if you can delay it, and not pay tax in those earlier years. So we gave an example of people that want to continue to work, but what if you don't want to continue to work? Maybe just live off Social Security for a few years. There might be a time where you're not paying any tax at all in your Social Security, like for maybe that extra 5-year period until you're 75. So I think Social Security tax, there's a good opportunity there. And then Medicare, like with your premiums, a lot of you probably watched those. There's those different tiers. As you get over these income tiers, you're going to be taxed, or you're not taxed, but you're going to have those higher monthly premiums as you're in those higher brackets. So I think watching all three of those, your income tax, Social Security, Medicare impact, if you watch all three, I think you could have some significant savings.
That's brilliant.
Along those lines, Brent, what are some of the biggest mistakes that you see retirees make, over your long career and in practice? What are some common mistakes that retirees make from a tax perspective?
Yeah, all kind of tying back to this, like one of my favorite ways to plan with retirees is that income tax bracket planning, and just projecting. And you've got to project it out over years. You can't just look at it for 1 year. You've got to know, like, in 3 years from now, will I be taking Social Security, or what will I have as far as income goes? And I think the biggest mistake they make is just not having that proactive planning, just thinking, oh, we need this money, let's just withdraw it. Or in some instances, you might have, like, if you delayed that distribution till like a month later, like say January 1st of the next year, it could save you thousands in taxes. So I think that's a big mistake, just not planning proactively, not watching your brackets. And it can be very, very daunting. Here, let me share my screen real quick.
I was going to say, you missed an opportunity to say it can be very taxing.
Yes, it can.
I'm a dad, so I can say dad jokes.
It's a good one. It's a good one. So what I would do, let's see, is my screen is sharing now, right?
Yep, we can see it. Yep.
I would make sure you understand tax brackets. I'd say it's a very, very common just misconception about what tax brackets are. I'm sharing the wrong screen, but you could pull up tax brackets every year. These change every year, but just understand what a tax bracket means, and understand that your income, as you're going up in your income, you're not changing like all the lower tiers of your tax brackets. You're filling up these different buckets of tax brackets. So as a quick example, 0 to 20,000 when you're married is taxed at 10%. 20 to 80 is 12. 83 to 178 is 22. If you go $1 over these brackets, it doesn't change your brackets below that. Remember, it's only that $1 that's over that jumps up into that higher bracket. So I think understanding that will have a huge impact on how you think about tax planning, just understanding those brackets.
Yeah, that's brilliant. And then obviously when it comes to things like Social Security specifically, the potential for pushing Social Security into a taxable space where, it doesn't always have to be taxable if we don't have too much income to report.
Yeah. And then remember the difference between taxable income and adjusted gross income, and I remember in tax class, like 15 plus years ago, I'm like, it's all the same. Like, it's net income. I was like, started with bookkeeping and accounting. Then you get into the tax side. There's so many different variations of it, but understand those words, adjusted gross income and taxable income, because Social Security and Medicare will go off of one or the other. You got to pay attention to that.
Yeah, very good. So we'll switch gears a little bit here. I think we do in that lane, I guess, a little bit, but people, and Brent, I don't know, you're still sharing that screen. I don't know if you mean to be, but
yeah,
you're good there. So the new act adjusts catch-up contributions. Would you mind walking us through kind of what the catch-up contributions now look like, and how that could also be a benefit to people that are approaching retirement?
Yeah. The catch-up contributions, it goes up to $10,000, which is giving, what was the prior one? Was it a 5,000?
Yeah, for the catch-up. Yep.
Yeah. So so it's doubled. So now if you are getting closer to retirement, when you're older and you want to do these catch-up contributions, I think being able to do more is a great opportunity. And I'm not going to say I like them. I like them in certain circumstances, and it really depends on running the numbers. So if you're in a high tax bracket year, say you're getting close to retirement, and if you're in those 37% tax brackets, like showing the income over here, say you're making $500,000 a year and you're in a 35% federal tax bracket, and you do a catch-up contribution, an extra $10,000 deduction is going to save you $3,500 in taxes. And then you got your state savings as well in whatever state you're in. So if you're saving about $4,000 in tax on a catch-up contribution, immediately you're $4,000 ahead. And then let's say the very next year, so we'll say like so year one, you're making 500K of income, and you save, we'll say your savings are on the $10,000 catch-up contribution. Man, if you can read my handwriting, sorry about that, but
No, you look
your
good.
savings might be about $4,000 in year one. And this is taxable income there. If in year two, say you retired in year one, so then you go over to year two. So year two, let's say your income goes down to $100,000. So income went down to 100. And let's just say, for the sake of this, let's just say you're not doing a catch-up contribution, but now you want to pull that money out in retirement. You okay? Well, now you're going to have taxable income. And actually, we'll do this. This catch-up contribution was a deduction, but now you're going to have taxable income of $10,000. So your income went up, but now what bracket are you in? Now you're in at $100,000 when you're married. You're in a 22% bracket. So just by transferring, getting a deduction in a high bracket year and taking it as income in a future year, I want you to see that what the difference is. So now you got savings of 4,000 there up front. And actually I want this to be a little more clear. We'll just focus on federal taxes. So savings in this example were 3,500. But then over here, you're going to come back, you're going to pay tax of $2,200 because you're in the 22% bracket instead of 35% bracket. So in that little example of just taking a deduction, and it could literally be December 31st, you put the money in, January 1st, the next year, you take the money out, you would save that much in taxes. But if you left it in for a full year, or there's future years of growth while you're in a lower bracket, all of that growth would be taxed in your new lower bracket instead of the higher bracket where you first put it in.
Yeah.
I like this a lot too, because those later years often coincide with higher earning years, right? Where you have more capacity to save.
Yeah.
So I like it. And as far as how the specifics of how this will work, starting January 1st, 2025, individuals age 60 through 63 will be able to make those catch-up contributions for $10,000 annually. So can't quite avail ourselves of it yet, but in the next couple of years, that will be coming online.
Yeah, and there seemed to be some nuance in there too, Brent, on higher wage earners. The catch-up would be attributed to Roth. Is that correct? How does that work?
Yeah. So I think the limit's like 145,000.
Yeah.
And there's a lot of different limits with these retirement contributions and when you can actually take a deduction. So if you are putting money in, say in these later years, and you're over the 145,000, it would need to go to Roth. There might be some self-employment. If you're self-employed, you might have some very good deductions related to catch-ups that could actually be deductible. But with the Roth, you do not get the deduction as it goes in. So in this example, let's just say this is Roth. We're going to take out the savings because you do not get tax savings when the money goes into the Roth. But then in year two, and I might bring this out to maybe a few more years, let's go down to year 10. So 10,000 still went in. We'll just say money in. 10,000 still went in there. Actually, we got that up there. Year 10, let's say that same $10,000 is worth $15,000. And I'm usually not doing projections on future investment growth. That's what these guys could do for you. But if
you follow the rule of 72 in year 10, if you were averaging 7.2, you could double that money, right?
Okay, so we'll go with $20,000. So now it's worth $20,000, and you go to pull that money out, you're not going to be taxed on any of that money. So you did not get a deduction when it went in. So if you pulled that same money back out, you're essentially the same off for the first 10,000, but that extra $10,000 of growth is 100% tax-free as a Roth or under your Roth. So if you're in that 22% bracket, you're still saving $2,200. Or
Yeah.
if it was $100,000 you put into a Roth and that doubled to 200,000, you're saving $22,000. So of course, the more you put in, the more savings there are, but
Yeah.
just understand that as well.
Yeah. So not necessarily a bad thing that, higher wage earners do a catch up, they can still get a Roth benefit from that.
Yeah. Yeah.
So while we're on this topic, Brent, maybe to dial in a little deeper. So with Secure 2.0, one of the provisions in there is employer match contributions can now be Roth contributions. That previously wasn't a thing. If you're, and I know it's client specific, but just generally speaking, do you like the idea of having the employer match be Roth, or do you have a preference to have it be traditional? Where do you kind of land on that?
Yeah, I like Roth. I'd say more often than not, I like the Roth contributions, like across the board, even for our clients that are very close to retirement. Because a lot of times, even if they are close to retirement, a lot of times they'll have other accounts that might be taxable accounts that they could start drawing from even the next year after retirement. But even like the year before they retire, a lot of times I'll recommend Roth and then just say, well, keep it in that Roth account, let that account grow over the years, and you'll get all the tax benefits of it growing tax-free. So I think that opens up a lot of really good opportunity for people. But like as a general rule of thumb, I'll tell people like when they're younger, Roth will more often than not make more sense. When you're like average or lower income, Roth typically always makes sense. Like the traditional ones, I usually only like those when you're in the higher brackets, the higher tax brackets, to just get a bigger first year tax savings to maybe where it might take you longer to have more money or more time in the Roth to make up for the lost tax savings initially. But I think it's a great opportunity.
And in that vein, I know we'll get a lot of questions on this regularly about Roth conversions, right? So not necessarily the contribution part that would apply to the Secure Act 2.0, but the conversion after the fact. What is your feeling on a Roth conversion, and are there windows of time where it makes more sense than maybe less sense in a Roth conversion on a retiree?
Yeah. As long as you can run the numbers on a Roth conversion and you understand that first year you are taking a tax hit. So on a Roth conversion, let's say in a year you did $100,000, and if your tax hit, and the planning with Roth conversions that we work with on clients, with their financial advisors with clients, if you're in a low income year for whatever reason, I think it's a great opportunity for Roth conversions. And so more often than not, in those low income years, I'll recommend it. But even in those high income years, I'd still run the numbers. So let's go back, like that example of someone that was making $400,000 or $500,000. They did a Roth conversion. You're going to pay tax of what was it? It was the 35% tax bracket. So even running numbers, sometimes if you have enough time, a Roth conversion, even when you're in these high brackets, can make sense. So let's say year one, you've got $35,000 of tax on the $100,000. Go out 10 years or see how many years it takes to make up that lost tax. So you've got to reset your calculations, because you're starting off, as you're growing, you're starting off with 65,000. And then I would run an analysis like this. You go, okay, well, year one, we're starting off with 65,000 because we paid the tax on it. Year two, what's your account balance? So maybe you go, okay, well, now we're at 70. You go year 10, okay, well, now look, now we're at 100 and whatever it is. Say we're at $140,000 on year 10. So if you needed the money, you've got to look at that break even. If you needed that $65,000 or if you needed this $100,000 in year 4, 5, or 6, it might not make sense at all. You might as well, you may have just wanted to just left it in there.
Yeah.
But if you carry it out, you're like, yeah, I don't need this money for 10 years. And you have other funds to fill in that gap for those 10 years. That's the 10-year mark is kind of what I use. I'm not a financial advisor for clients, of course, but as we're working with their advisors, it's like, if you can hit that maybe 7-year mark, 8-year mark, and then by the 10-year mark, I think it would always make sense if you don't need to access the funds before that time.
No, I like that.
I think one thing too, Brent, that sometimes tips the scales is when you have depreciated asset values. You know, it was a rough year last year for the market, for example, and often a big decline in the market. Not always, but is often followed by a pretty sharp increase. And if you can convert at a depressed level and then immediately have a good bump on the other side, that sometimes tips the scales as well. Where do you land, Brent, on the notion of paying for the taxes on the Roth conversion out of the money being converted versus bringing the tax money or the tax liability money to the table from another account? Where do you land on that discussion?
Yeah, if you, and I think what you're talking about there is like in my example, I said you're withholding the tax and then your newly invested funds in the Roth would only be 65,000. But if you want to start off, if you have access to other funds, I think it would be better to start off with the $100,000 base level. You raise that 65, start off at 100. But of course, these funds right here, out of that tax, you'd have to pull from other funds. But what that does, especially if you're in like a depressed level, like in the market now, get $35,000 more in immediately. I think it's a much better opportunity for you to grow your investments faster because you're going to have more basis, more principal for it to grow on.
And it makes a strong case for diversity in planning, right? Where rather than saying let's have everything in a traditional or everything into a Roth, using non-qualified investment planning as well, makes a strong case to say, hey, get an advisor that really helps you lay out all of the tax implications within your investment opportunities.
Yeah. Yep. Exactly right.
We might have a time for one or two last ones, and I was curious to get your take on the Secure Act. Seems to soften some of the penalties associated with accessing our money now. And in prior years, if we missed an RMD, it's a 50% penalty of everything that we were supposed to have taken. How did that rule change?
Yeah, specifically with the penalty, the penalty goes down? What does the penalty go down to? Is it 25%?
Correct.
Yeah, 50 down to 25, and then for immediate corrections made, it goes down to 10%.
Yeah, like that. It is absolutely insane. The penalty before, and even the penalty now, or the 25% is still really high. But that's if you didn't take your money out, they could, of that RMD specifically, before it was 50%. I think that's better, or I think it's way better, of course, but I think most people seem to stay on top of that because it's such a big topic. And as they're getting closer to that age, I think people have been a lot better with that. They are easing up a little on, like, there's the 10% penalty. So before you take RMDs, but the 10% penalty on drawing money out, they're a little more lax. There's more hardship exemptions, other ways where you can be exempt of that 10% penalty. But
pre 59 and a half, they've added more exemptions. Yeah. And that's been helpful too, because on the other end, you'll see people that want to retire early but feel a little bit, being held hostage to their employment because they don't feel they can access their money prior to that number. Yeah.
Yep, that's right.
Yeah. And maybe a parting question that we'll end on. We have in our area, obviously, we've got a lot of very generous people. What tips and tricks can you give on things like charitable donations, QCDs, in-kind donations that you see being very helpful to retirees?
Yeah. So a couple ideas for charity. So I'd make sure you understand what QCDs are. We'll talk about that just for a second. It won't take too long. Make sure you understand what charitable bunching is. Donating appreciated. So I'll say appreciated donations. And then the last one I'll mention real quick is donor advised funds and those DAFs. So QCDs, I don't think they changed the age on QCDs yet. They probably will, but when you're 70 and a half, you can donate money directly from an IRA account to a charity. And what happens there is you skip out on the income reporting side and the deduction side. So if you're taking the standard deduction, you don't have to worry about being over that limit. You don't pay tax on that money at all. You just kind of skip the whole process from reporting on your tax return, or at least the impact on the tax return. On the, well, I didn't write this, but charitable bunching. So watch as you are, watch your standard deduction and your itemized deduction limits. For a married couple, it's at about 25,000. If you're not over that, if you're taking the standard deduction every year, but you are donating to charity, make sure, like the QCDs, like I mentioned, make sure you're either doing that or you are bunching your charity. And that involves like doing, say, 2 years of charitable donations in one tax year to get you over into the itemized deduction limit. And then in, say, that second year, you don't do any deductions, or the opposite. You could not do it in 1 year and then do 2 the next year. And then this doing your appreciated donations, that's when you say you have stock. So you've got Apple stock that was worth 100 when you bought it. Now it's worth 10 grand. If you donate that 10 grand, or if you sold it and then donated the cash, you're going to pay tax on the 10 grand because it appreciated in value. And then you'll get a deduction for the 10 grand. That's if you sell it, then donate cash. But if you donate the stock itself, you're going to get a $10,000 deduction, and you don't have to pay any tax because you never sold it. You donated the stock, but you get a $10,000 deduction for the current fair market value at the time of the donation. Like, that is a really good planning opportunity. And then donor advised funds. I like donor advised funds and charitable bunching. I view those as being pretty related, but that's a donor advised fund is where you can go deposit money. Like, say in 2023, you deposit money where you want to go to charity in the future, but you say you haven't decided where you want to donate it yet. Or like in Utah, we have a lot of people donating 10% of their income. And a lot of churches donate 10% of their income. If you wanted to do the charitable bunching, you could put it all into the donor advised fund here first, get the deduction on it, and then distribute out of your donor advised fund in future years, say at that 10% rate down the road. So I would use all 4 of these just kind of interchangeably, and in your planning, just make sure you've got all those tools in your tool belt as you're going through it all.
I love that. One thing that we like to tell our clients is this kind of thing here isn't April discussion when you go to file your taxes, right?
Yeah.
This isn't a March discussion when you go to file your taxes. This has to be done during the year for the following year's taxes. And so that makes another strong case for, having an advisory team in addition to your accounting team to really walk through how to maximize your investments for tax benefits throughout the year.
And Brent, I love kind of thematically what you touched on earlier on in the discussion here, where it's important to always zoom out and have a longer term plan. So not just thinking about it, to Paul's point, in the year that it's occurring, it's too late at that point, but zooming out and having like a 10-year plan where, hey, this is my long-term strategy, and then executing on that plan. So I think that's an important point that you brought up earlier.
Yeah, exactly right. Yeah, have the long-term plan, and then just really see how all these different things apply to you specifically. We have clients call us about TikTok videos or things they saw on social media, or their buddy mentioned something. It's like, that might apply to you. Let's run the numbers. Let's go through the tax law. Let's go through your situation and apply it there. That's really where you can get the change and save on taxes.
Absolutely. Well, Brent, we sure appreciate your expertise and your willingness to jump on our call this month. I know that everyone on the call that got to listen was able to learn quite a bit and benefit from the information. So we appreciate you joining us today, and for all those who are on the call, appreciate you guys joining us as well. And until next month, thank you, everybody. Have a good day.
Thanks.